Hello, everybody. A little bit later than what I wanted to record at, but uh, this is a crazy day in our house. My name is Daniel Young. I'm the owner and founder of Adaptive Perspective and the Adaptive Perspective social media platforms. And I am back to talk about the stock market and our specific stock market investment strategy and how we're using that to build wealth and just honestly completely bang out dividends. So let's get the regular, normal disclaimers out of the way. This is an unedited video. Who knows what you'll hear in the background as I film these in my house. I am not a financial advisor. I am a strategist and a financial strategist, and I don't speak like a herd. I walk in limited company, and sometimes I walk alone. Uh, I guess. Well, first things first. I did start the Substack. Um, it's very much a work in progress. I'll show you what it looks like so far. Oh, I'm sharing. I don't know if you can see. Maybe I can move this out of the way. This is what I have so far. That's the image because this is the 12 steps to financial freedom in the sense of this is the ebook I'm writing, and this is our financial system. And as you get up the stairs, you'll notice that the closed-end fund system sits towards the top of the stairs for what I would say are obvious reasons. It's hard to, gosh, it is hard to climb yourself out of the debt grave productively, effectively, if you are investing into the market and not taking care of some essentials first. But this very much is a work in progress. So it's on there, but there's not much on there. So I will update more as I go. Um, and we'll go from there. Re Regarding the normal stuff, um, I could ask you to help me hack YouTube and comment and like and share. And all of that would be true, but really just help me get the message out and help more people because there is a much better way to invest than the standard 1.2% dividend you get out of the S&P and the buy and hope and buy and wait and have your overall principal just eaten and shredded with inflation. So comment on the videos, like the videos, share the videos, and help me get the message out. And if you've got comments about how I can make the videos better, if you want to comment about what you're investing in and why, or pick my brain about something else, then by all means, drop me a comment. Um, and I'll leave that at that. So I know the market looks different this week, at least on the surface, right? Last week we were in greed territory with tariffs coming. The end of this week, tariffs hit on Friday. The panic media is already panicking, um, and they've had the weekend to just sow this fear into every herd investor. And who knows what Monday will bring. Uh, but quite honestly, I'm betting on a down market or at least a dip because it presents a much better buying opportunity than buying at those previously inflated prices. So I know it seems like the same market, at least on the surface, but it's still a little bit different. And it I would argue that it's more like show and tell. The market is showing fear, but it's really not. The herd didn't learn the last time. So if you're paying attention, you already know what's going to happen. The herd will freak a little bit, the market will dip. Everybody smart will buy the dip and not sell. Will buy the dip, and the market will come back and hit a new high. So what did we learn this week? The Federal Reserve continues to prove that we don't need the Federal Reserve. They're supposed to be reactionary, not dictating the terms. The Fed's goal is to control interest rates based on the data and raise and lower interest rates based on the data. They're not doing that. So the economy is chugging forward. More oil is being produced. President Trump is generating billions and trillions outside the country. Doge is still cutting. And all of this extra money is getting floated and input and installed and built inside the United States. And the Federal Reserve is still pushing this very stupid, very foolish mantra that they are afraid because they don't know what tariffs will do to the interest rates. They don't know what tariffs will do to inflation. Bullshit. Like flat out bullshit. Jay Powell is an ass, or he's just completely incompetent. And he's not completely incompetent. He got that job for a reason. So he's an ass. He's holding on to leverage. The Federal Reserve Board that we don't need is starting to fracture, and people are starting to break ranks. We should cut rates. One, two, three people are saying that's not how this has worked in the past. But it really comes down to the decision of one guy right now. And he's refusing to lower rates because he's afraid of tariffs. It's the same guy that told us he didn't know how we had so much widespread rampant inflation after he printed 40% of all currency in existence within 4 to 6 months. So the head of the Federal Reserve, who's supposed to know what inflation is, admitted on TV and at his conference that he didn't understand inflation. And the panic media bought it. And my third grader or fourth grader at the time was like, that doesn't make sense. So now the same guy is tasked with dictating the terms of dictating short-term interest rates when all the data says we should have cut rates 6 months ago. Heck, they cut rates right before the election to give the incumbent a really good economy going into the election. So we cut rates when rates should have been high before the election. Post-election, when rates should be low, he's kept rates high because he's unsure about tariffs. This is the guy that's got more information beyond everybody outside of President Trump and the Treasury Secretary. He's got so much more information than we do. And yet you and I can see by past studies that tariffs are not inflationary. And the federal chair is saying, oh, wow, tariffs might be inflationary. We're going to keep rates the same. It's a man that is bent on power, bent on power. He's not doing his job. And he's proven him solely because it's a board, but his decision. He's proven that we do not need the Federal Reserve. Now, how do you go around interest rates? Everybody's so caught up in interest rates. I think that problem goes away when you put us back on an actual standard. And it really doesn't matter the standard so long as it's a fixed standard. Everybody targets the gold standard. Make 1 ounce of gold equal X amount of dollars, and you have a definitive value on the worth of $1. But I don't care if it's gold or silver or copper or bronze. Make it a standard, because currently the value of $1 is only what people value that $1 at. So the imaginary system of money. Currently, $1 is only as strong or only worth $1 based on how other people think that dollar is valued. So now interest rates come in and they tell you how much that dollar is being devalued. So if interest rates or if inflation is at 2%, then it's being devalued 2%. But that's not really true. If it's being devalued at 4% or 6%, right? And we're trying to curtail interest rates based on inflation, but that's not what Jay Powell's been doing either. He's been keeping rates the same when they should have been cut. Because if his job is to pay attention and react, he's not. He's dictating the terms. But I say, honestly, we get rid of the Fed. We don't need the Fed. The Fed has proved itself obsolete. If the Fed will not adjust interest rates based on the data, and that's their job, then why do they have a job? Currently, the Fed creates a problem just to fix the problem, and it's the same thing. Like that doesn't work anywhere. If you caused a giant explosion at your office, would they then hire you to fix the building? No. The Federal Reserve created massive inflation, and at the same time, they got fixed to fix the problem they created. And currently, they're supposed to react to data, and instead, they're trying to dictate the data. We don't need the Fed. Like, I don't care if Jay Powell stays the chair, he can be the last chair the Federal Reserve ever has. We don't need the Federal Reserve. Put us back on an actual fixed currency standard, gold, silver, bronze, brass, copper, whatever. Put us back on that. We don't need the Fed. And all those interest rates don't matter. So, yes, we don't need the Fed. The economy is chugging along. President Trump is bringing in loads of money. Doge is cutting money or cutting wasteful, wasteful spending, excessive spending, however you want to term that. And yes, tariffs aren't inflationary. Tariffs simply bring people to the table so we can talk about stuff. They also act as an income generator on steroids. It's like souping up your car. It's like taking the standard 9-volt battery, right, that you would put in a smoke detector and then hooking up a car battery to it. Like, it is on steroids. And we are raking in money to the point where President Trump has circled back to the idea of eliminating taxes for certain income groups. Think about that help to your income. So not only do the Trump tax cuts become permanent, tax cuts for everyone. So not only are the tax cuts permanent, but you would also get no federal taxes at your. Currently, I think he's floating the idea of 150,000 down, but I honestly think it's going to be more than that. So if we can get the Fed to actually cut rates with or without Powell, or I mean, it'd be great if we got put on a gold standard, silver standard, on a standard instead of imaginary money, and then get the oil and the natural gas pumping, we will jailbreak the economy. Like, the economy, cut interest rates 0.25%, and the economy will open up. So when it comes to spurring the economy, Economics 101 says you cut taxes, which we just had, and you cut interest rates, which the Fed's not doing. Economics 102 says you put oil production on blast to lower everyone's cost and drive down inflation across the board. So we had the tax cuts and we're increasing oil production. What we need is for the Fed to do their job, not what they think is their job. But yeah, my cat's feeling needy at the moment. But what we need is for the Fed to do their job and regulate based on the data and not based on one man's opinion. And with all that in the works, that puts us in the gap between waves. So if we look at how the market is, right, between the rise and fall of the market and the rise and fall of fear, and we look at trends, we're in the current gap between the wave we were on and the next wave. And normally that's called a trough. My cat's needy. So normally that dip is called a trough, but that would insinuate that we're below a standard level because the trough actually hits below even, kind of like sea level. I don't know if he's going to climb in my lap or not. He hasn't. I don't know if he's been on a video in a while. Here, let's see if I put him on. Come here, buddy. Everybody who doubts that I have a cat and it's not just some random thing in the background, this is Kenobi. He's a hairless cat in tuxedo. Like, that's his designation within breed. He's a hairless cat. He's a Sphinx, but his coloring is called tuxedo. And he's very squirrely at the moment. He wants attention. He wants somebody to play with his favorite fishing pole toy, and he's very distraught that that's not happening. So let's see, waves. So we're currently in the gap between waves, right? And we're not exactly at the trough because that would be below sea level. So instead, we're more like we're ascending from the trough of where we've been in the last 4 years, and we are currently climbing or riding the swell to the next crest. Surprisingly, not my cat. So as we continue to ride up from the dip, it really breaks down into one simple question. What do you think is worth our time and money? If you're going to invest in anything, what's worth your time to look into that, and what's worth your money so you can invest in that? Now, what would benefit the most from a rate cut? And yes, everybody's going to say everything will go up, like everything got to go up in cost and value, which means the odds are ever in our favor of picking something great, right? When the market dips and everything is trash, or at least cheaper than it was, and you're going to wait for it to ascend back up to where, like, so if it drops from, pick a number, if it say it's at $10, drops to $9, you buy it close to nine, it climbs back to 10. Oh, look, you've already made $1 per share. That's great. And then it continues climbing. So it's easy to pick stuff when that happens. But if we can really increase our odds of picking up a great fund or a great batch of funds, where would we most likely see a short-term increase, or like a short-term increase of value, and a long-term benefit? Dividends, equity gains, what puts us in the best position past one day, or really days and years from now? Because the market moves in trends, right? We've been in that bond fix for a while, where bonds are the best place to be. At some point, we're going to shift out of that. And that might be coming, it might not. It really just depends on how things go. So, where is the best place for us to be? And honestly, it's the same place we've already been. So long as rates are high, bonds and bond proxies are where to be. Now, if the short term rate drops, would the long term rate drop too? And no one really knows. I don't know. Um, so I think there's a slight word of caution in that, depending on how your overall funds are invested long term. But at the same time, the best place for us to be is still with bonds and bond proxies. Now, inside that bond proxy heading or umbrella, you've got real estate, business development companies, utilities, energy transfer, and CLOs. And the CLO market right now is taking a hammering. Like, fear is moving in that bunch like nobody's business. I mean, I won't say the floor fell out, but it's pretty much how it feels. It's If you look at interest rate, I mean, interest rates set the tone. And if you're plugged into that corporate media conglomerate, you're not exactly getting encouragement. You're getting a lot of fear because fear sells. So, and I think I put this further on, but maybe not. Or maybe I thought I would mention it and then I didn't. If you think of the herd, we talk about the herd as kind of like mindless sheep. Like, they follow the bell and they would follow that bell off a cliff. And that's true. But the other analogy that works is if you consider the herd like a school of baitfish. Like, if you watch those, uh, well, maybe you don't say, I want to say on Outdoor Planet or on Outdoor World, they track the migratory baitfish balloon. It's this massive wad of baitfish that travels from eastern Florida up the East Coast. And they look at all the different fish that benefit from this baitfish swell or baitfish swarm. And whether it's fish or sharks, right, anything bigger than a baitfish, they're all corralling those baitfish into this one giant ball or bubble. And then they just attack the crap out of it. And that's kind of like the herd, too. The herd feels comfortable in a group. They feel comfortable where they're led. They may not like where they're led. Just because it's not to say that they are not unaware, right? They may not like where they're going, but when you're bottled up with fear and you're being steered a certain direction, you're going to go because it's the best option, because everything else is more scary. So as the herd or the school of fish gets steered into one corner, they sell off, they're fearful, and it's really the best opportune buy on the planet. Like, in the market, when the herd goes whoa and they turn a right corner and it leaves this giant space, the sharks attack the school of fish. The sharks also attack that empty space. So if you can bottle up the herd in an area, it almost creates a vacuum and it allows other people to come in and buy things for cheap. So it's kind of how I view the CLO market. Now, it's scary in the sense that CLOs have depreciated in value significantly because the herd fears debt. They fear the idea that interest rates are high. They fear debt as a whole. It's kind of like your credit card. Are you sandbagged in credit card debt, or are you paying the credit card back on time and getting points back? Most people in the herd are sandbagged by credit card debt versus paying off the card and getting the benefits. So the herd itself is panicked about the CLO market. It's a great place to get great dividends, but it's a market space that is so complex and convoluted, and you're really not going to understand everything that's involved. It works like a bond market. It's in a bond proxy market, but pick your jet unless that's just your specialty, you're not going to understand it. Now, I can sift that information a little bit. I read a lot of people who understand it a lot better than I do. And I can have AI sift what those people are saying, and it still comes back as almost gobbledygook. So is it something that I want to plunk to, like, is it something that I want? And I say that I don't want to diversify and I just want to know what I want to invest in. But is it something like where I would put all my eggs in one basket? No. But it would be on my list and not even looking at the list. Like I know it's kind of on the top picks for the list or top picks for the week, but picking up another set of our CLO fund is tempting. And I get it. Like it's risky. The market suffered. I get all that. But when the herd and that school of fish leaves and they just prices drop out, it's a very tempting opportunity for me. So I'll get back. So where should we be? Bonds, bond proxies, oil. Oil is on it's almost like the tech market in a sense. We're on that up, like when you ride a roller coaster and you leave the platform and you start to hear the clicking of that cart being pulled up the ramp, we're at the lower end of that threshold. Like it's clicked a couple times. And it's between oil and technology. Technology's next golden age is here, but we're still at the very bottom of that ramp. And oil powers that technology revolution. And we are at the forefront of the next massive push in oil production. So if you could find oil cheap, that'd be ideal because oil is used by everything and oil byproduct is used by everything. That sounds great. So following oil would be tech, but that's not just tech based funds. Like that's not just Google or Meta, or I guess Google is Alphabet. So Alphabet or Meta or Amazon or Taiwan Semiconductor or Microsoft or Apple. It's not just those guys. It's anybody that would profit by the advances in technology. And you could argue again, that's everybody, but there are specific sectors who will significantly advance with another technology boom. So in that, right? So that sounds like a great idea for stocks. But if you're buying stocks just because you think it's a great deal with the dollar in decline, you're not winning that argument. And I say this because there's a lot of talk of the declining dollar. Like if you look at the overall value of the dollar, it's declined about 10% for the year. But that doesn't quite hold water with me, right? So if I'm looking at the news and I'm listening to AI, which is highly congested with the news, and I asked Google AI, why has the dollar declined? And after reading it, it's honestly it's because the herd has responded exactly as you'd expect. So Google AI fed me this answer. The simplest explanation for the decline is that global investors now expect the US economy to no longer outperform the rest of the world as a result of President Trump's tariffs and worsening fiscal issues. All right, my bait fish. So, like you would expect, That school of bait went, oh my gosh, and they panicked, right? But if you've got to remember who's doing the steering here, all of these online experts, all of the talk show experts, it's all this supposed batch of experts who are the stock market experts this week. And then next week, they're an expert on tariffs. And then after that, an expert on student loans. And then they're experts on teachers' unions. And then fast food corporations. And then international affairs. And if they're if they're an expert on one thing, then that's what they're talking about. But if they're an expert on everything, you're really an expert on nothing. And with that, they have all been proven wrong, which just says they're not experts, right? And that's the bunch of people, or that's the group of people who is schooling the herd between the small fish. So bait fish can be any size, pending the size of the predator, right? Or the size of the bigger fish. Or like Qui-Gon's remark that there's always a bigger fish. So if your pack of 6-inch cigar minnows, and there's thousands of them, if any of them get a whiff of terror or a whiff of fear, the whole school moves as one to form this entire giant bait ball in order to protect themselves. It's hard to get one, like it's hard to identify one when you're seeing thousands. But on the predator side of things, they school the fish up together, they bunch the fish up together because as they careen through the bait ball, they're not just looking for one. It's like a whale shark through plankton. Like your or I think that's the right analogy, or just a whale through plankton. It's open mouth going through the bait ball and getting as much as you can. So if you recall back to tariffs 1.0, these experts freaked, the herd freaked, the market dipped, and guess what? We came out better on the other side. And here we have the same thing. The dollar is losing its confidence. Tariffs are bad, right? Worsening fiscal issues. And what happens on the other end? Everybody's wrong. We come off in a better spot. So it's really hard to take the line of the herd. It's even harder to take the line of the people who are advising the herd. So why say this? This is convoluted now. Buy stocks because they're a great deal, or they're on discount, or you can see a long-term opportunity. And that goes with anything. But do not spin me on on the declining dollar narrative. Inflation is down. That's supposed to improve the overall value and worth of the dollar. So if we're using that other stipulation that the dollar is down and companies are cheaper, then wouldn't your dollar also be worth less too? So I'm getting something cheaper and using a cheaper method of buying. That doesn't make sense. I buy US stocks because everyone wants in this market space. And the US and China are competing for the next technological advance. It's like it really is the next Cold War, right? But maybe I don't it's not a Cold War, but it's a technological war. And President Trump is maneuvering us to outpace China. And if you look at all those trade deals, countries are shifting away from China and they are siding with the United States. So that doesn't sound like the dollar is in decline. That doesn't sound like the dollar is losing value. That sounds like the narrative, but that doesn't actually sound like the story. So, what does that mean for us? What do we need to look at this week? There we go. So this is the closed-end fund master, and it got an update, a much larger update than normal. Um, I want to say I spent a good 10, 12 hours on this weekend. I did the general update. I updated share costs. I updated dividends. But then I went through and looked at all the discounts. And quite honestly, I'm still not done. But I did a significant amount of updates to the point where you'll see a lot more triple asterisks because I finally did a full. That's not to say I didn't do a full update, but I did. I did a more involved update, something I've been wanting to do for a while, to where every significant. I mean, this one isn't because it's an annual dividend, or no, this one is not. Former fund, category three, not impressed. Almost every other white box got an update. Um, yeah, and I'm not done updating. Um, my goal would be to look at our triples. I mean, the singles, yes, or the doubles are there, but look at the triples and really dig into these portfolios and see if I can put a snippet of information down for every one. Uh, but I didn't have the time. So I did go ahead and take that list and input it into the spreadsheet. And we're going to sort based on these factors after we do some preliminary screening. So we're still going to look at bonds. We're going to look at bond proxies. We're going to look at tech. Oil is feasible, but not directly based on what's available in the closed-end fund market space. So every fund on here has a significant discount compared to its historical average. Um, let's see. We'll update. We'll do this way first. So I like monthly dividends. If you've watched my videos for a while or even a week, you know that I like monthly dividends. I really dislike quarterly dividends because I want the dividend paid every month. But I have bought one quarterly dividend. I bought this one because besides NBXG, I have not found a better USA based, solid track record, long track record of tech, like limited investment, like highly specific investment into technology and some other funds. I just haven't found anything better. That is until I looked at some stuff this week. These two funds are sister funds. Uh, when I was at Webull, they forced me into a drip program, a dividend reinvestment program for this fund. I could never take the dividends in cash. It was only ever in an automatic reinvestment program, which I like to direct my own dividends because, I mean, yes, we could buy USA tomorrow, but then the next week, maybe it's not a great buy anymore. So I like cash dividends. And these two are sister funds. They play a slightly different ball game, but they both play the ball game well. And yes, it is. They are stacked with blue chip stocks. Both have a decent long track record, or not USA. These, it, both are blue chip powerhouses. Both still have a long track record. Both have, both will gain in value. I think I've seen USA go as high as $9. I think, but they pay a stellar dividend. That said, it's a quarterly dividend, and it's not my favorite. But if I'm being honest, they've been on my wish list a while. I just have steered away from them because it's a quarterly thing. Kind of an off quarter. This is a alternate category two because it should be 25811. This is like an alt category three in the sense that it ought to be 36912. Um, but I'll back up just a little bit. So instead of sorting by month, the easiest way is to sort by name. because I am not an Aberdeen fan. Owned an Aberdeen fund, not happy, not satisfied. I'm also not a BlackRock fan. So generally, I would omit the first three because they're quarterly payers, but we own this one. And these have been on my hit list. I always had them pegged as dividend reinvestment programs, and turns out they're not. So that leaves us with this. The next, oops, not dividend, yield. The goal has been 9% or better, and that's increasingly feasible at the moment. Um, I mean, expanding the list, yes, creates more opportunity, but based on the recent dip from Friday, right? Because the market finished below for the week because of tariffs on Friday. I'm curious what it's going to do this week. But we can eliminate more based on that 9% metric. The differences would be, and DNP will leave, these three will stay because they pay a tax equivalent dividend. So that's the dividend current based on my tax bracket or our tax bracket. DNP is an interesting ad. Like it's a decent buy when it hits close to that 52-week average, and it currently does. I mean, it's 0.03 off. Uh, so let's see what else we can get rid of. Love MDXG, but I would like to see them raise the dividend. ADX is a backdoor play into oil, which I'll show in a second. Um, Realty, and it should be. I would check the ex-dividend date. Pending the ex-dividend date, it might still be worth a buy. If you buy it after the ex-dividend date, you're not going to see a dividend until December. That's kind of a deciding factor on that. Let's see. Realty, of the three Cohen and Steers real estate funds, this is the only one currently on discount. Eaton Vance, I got into last week. Let's see. HFRO, the discount window has I mean, it used to be like 58, 59%. It's closing slowly. Um, Pricing has helped. Same thing. I still see light at the end of their tunnel. I would leave ASG on simply because it's been on my wish list a while, and 3% is not far from mine. DLY, we own the sister fund. They are structured completely differently, at least of what I can find on Morningstar. But we own DSL, DLY. Uh, if we added a bond fund, it would give us a different perspective, like a different angle into the bond market. But we're already heavily invested in bonds. So adding another one at over $15 just doesn't make sense to me. Vertus is on my sell list. CIF is a roller coaster ride in the Roth. That should not be color coded in blues. We don't own that at all. So I probably copied the wrong line. Or actually, what I probably did was I probably highlighted that, clicked the format, where essentially copies the format to where when I made that green, it also added those two blocks. All right, CTR, CI, FTHY, I don't know a lot about. Uh, I've I'm trying to think. I don't know a lot about. I've briefly looked into it. Doesn't really give us anything different than what we have, but I still need to learn more about it. Fins. I'll let you read fins. But yeah, banks and bonds doesn't. Banks probably different, but bond angle. we are covered on. RA real estate, I've looked at their portfolio before, um, but not at 13. DSL we own. Um, 2 weeks ago, it would have been a dollar cost average buy, but it's currently, excuse me, um, it's currently worth more than our average price. So it's not actually a dollar cost average anymore. Let's see. That stays. PDO, PDO like DNP. Uh, what is the other? PDO, ADX, DNP are the exceptions to the triple asterisk rule. And in this case, when its average is close to or exceeds the 52-week average, it's a great buy. And it goes to kind of what I said about DLY. It probably would give us a different take into the bond market. You're buying the brand. I mean, same thing as double line. You're buying the brand. So you were getting brand name pricing. Um, but we're already heavily invested into bonds. And with the market maybe looking to turn, it makes me maybe not second guess myself, but it makes me hesitate a little bit on buying new stuff when the bond market might turn a little bit. BRW we already own. Normally I would buy BRW and FCO together, but FCO is actually in premium this week. So I'll leave BRW. It's that overall discount has significantly narrowed. I mean, yet, yes, the year average is around 3.5, but at the same time, it's been wider of late. Um, let's see. So if you're doubtful of the US dollar, that's an option. Um, Eagle Point deals with CLOs. We already own a CLO company, and quite honestly, these two at the top would be my CLO picks. And that's not based on the yield. It's just based on company and track record. OXLC, I talked about last week. I mentioned an article that appeared on Seeking Alpha that was, which you can probably read for free in general. Like if you just Google search or AI search Seeking Alpha OXLC history, Seeking Alpha has made a lot of their articles free now. So that's a really good read. ECC is in a similar boat and really top three. Let's see. One, two, three, four, five. Yeah, the top five yields are all CLO funds. So uh, let's see. Octagon came well rated. CCIF came well rated. Right, Carlisle's claims to be one of the largest CLO managers, or OCCI. Then you have Eagle Point. So an OXLC we've been into for a while, and that's that Seeking Alpha article. I just made it a smaller URL because when I copied and pasted the URL, it was like 40 lines long. So if I went with CLOs, I would pick something we already have, and I would also pick a company with notoriety. I've tracked Eagle Point for a while. Carlisle seems to be a huge player in the business. Um, I would honestly go back and deep dive these funds kind of on Morningstar, but also on CF Connect to really see some differences. I guess these five. Um, CCIF is interesting. It really does. It only has 10 holdings. Um, yeah, so I'll leave these on the list for the week, but not all would actually like make the cut. I can always post a video based on what we pick because we would be buying this week. It is our week to buy. Probably wait to see how the market does on Monday. Maybe look at buying Tuesday or Wednesday. We'll see. Um, if the market roars back on Monday, then it roars back on Monday. Um, but I think after a weekend of fear, we'll get more fear from the herd. So I'll leave them on the list, but I can make an update video on what we actually bought. Of what's left, Hicks, yeah, Hicks doesn't outpace anybody. HGLB is weighed down with a wireless company, and I don't know if that's a good thing or a bad thing. Maybe it's good with the technological boom. Maybe it's bad because it's like it's almost a 30% asset location for one single company. So if that company does great, amazing. If it does bad, then it's just going to weigh on the portfolio. So I don't know. Um, River, of the assets they're invested in, outside of that, like we're already well diversified in the bond category, and I'm not a huge BlackRock fan. EIC is still Eagle Point, still CLOs. Um, I'll leave it in the sense that it's going to get lumped into the CLO investigation, seeing which, put it this way, I would pick up 200 shares of that easy. I've bought this in stints or sections of 200 in the past. I would keep the same metrics, same amount, and pick up 200 shares easy. Um, and if I was highly tempted, I would either pick, so 200 easy for sure. If I'm highly tempted, I would pick up 4 or 600. It's just a stellar price. OXLC rarely goes on discount. And this market space in general is in fearful mode or fear mode because of the prolonged high interest rates and honestly the sharks pumping fear. And the default rate is super low, but it's a market space that very few people understand. So it's really easy to pump fear into somebody because they just don't understand it. So if you're going to buy, so if you're going to buy a CLO, you want to find somebody who knows the market space. And I'll be honest, of all the different things I talk about, half that CLO stuff looks like gobbledygook. Like it just looks like a mess. You buy debt in tranches, and then you look for a tranche, and then it's this weird word soup on what a tranche might be. It's really like a section or a bunch or a group. It's just a really confusing, interesting market space, and you've got to be an expert in that. And you don't want someone at random advising you about a CLO. So I would much rather buy it in a closed-end fund. Better buy in, extreme dividend. Uh, but I also want it run by a company who is just balls to the wall and CLOs. Like I really don't want them to dabble in other stuff. CLOs and like CLOs and this. No, no. Like I really like this stuff seems to go together, right? But if it's like CLOs and I don't know, um, I can't even think right now. If it was like CLOs and real estate, like yeah, I get they both deal with loans, but it's a slightly different, very different market space. So you want somebody who knows what they're doing and isn't just willy-nilly doing a lot of different stuff. Um, all right, so that covers my CLOs, HGLB. This, I'm still, I would still bet on the US dollar, and things are not as bad as what people tell you. So that leaves us with this, and it looks like a lot, and I'll admit that it is like a lot. It is a lot, but it's that much because all of those funds are CLO funds. So outside of the CLO group, we look at HGLB, which has that 30% deal with Midwave Wireless. These things we already own. Yep, CLO, and that so it's 2 new Liberty funds. So it really depends on where you see the market going. Everything everything would profit in a rate cut. But if I think of the housing market, gosh, the housing market would move with a rate cut. Right now, we've got so many different houses on the market and not a lot of action. Bigger Pockets reports more individual buyers and less corporations buying. Corporations admitting that the higher interest rates are just essentially leveraging them out of the market. But an actual business real estate loan is significantly higher than what you can get as an individual, which we found out. So when we bought a house, the individual rate was, we'll say 6.5, and we were able to buy it down 1%. So whatever our maybe that 6.5 isn't right, but I want to say it was close to 6.5, and we bought it down. We paid out of pocket to get it 1% lower. But had we bought it through our business, it would have been 8 or 9%. And so these bigger corporations, even though they have a lot more money, are getting priced out of the single family home market because the business loans are that much greater than individual loans, which is interesting. I mean, it's great to see it's great to see people and smaller groups picking up single family homes because that means that BlackRock and Blackstone aren't. But it's just an interesting shift in the housing market. The housing market overall by us, there are tons of houses for sale with very little movement. You've got houses sitting on the market for 6 to 12 months to where they're taking it off the market, putting back on, taking off, putting back on, because they don't want to decrease the value of their house that much. So a 0.25% cut in the interest rates doesn't seem like a big deal, but it's a big deal. So I see a ton of value in the housing market. I also see a ton of value, potential value in stocks, not because of a weaker dollar, because that doesn't make sense to me. But what does make sense is more people pouring money into the United States and into US companies. That I see value in. Everyone wants to get in our market space. I mean, everyone. That's the whole point of the tariffs. That's the whole point of the negotiations. That's the whole point of people abandoning China and coming to the United States. So people want in on the action, and we're at the forefront of that. So getting back into US stocks, I can see a value to that. The best place to be, high interest rates, hopeful coming. I do think we still have coming interest rate cuts. The best place to be is bonds, but you can make an almost equally bonds and bonds proxies, which opens up a lot. But you can make an almost equally resulting argument for U.S. stocks. And the funds that I found that do it the best in the closed-end market space that are set up extremely well, MBXG, which it fits the discount but not the dividend. Right? I want to say it paid an 8.3 dividend. We bought it a month ago for 14.55. It's currently at 14.45, so it's 10 cents less. So it could easily come back on the list pending how much it drops. Because if it drops 30 cents in price and the dividend stays the same, it's going to increase the yield just based on that ratio. But the other three would be ADX, which has, right here, this is why I kept ADX on the list. So if you look at the year data, and this is just CEFconnect.com, compared to the overall data. I don't know what they changed right here, but it's like they got yes, the market dipped for any number of reasons. But whatever they did here, it's like they got a different management team or a rebrand or a restructure, and poof, it's just off to the races. But if you dig into the portfolio, and the reason why it's on the exceptions list, I look at stuff that's significantly different. ADX generally does not go significantly different. I mean, the 5-year average is about 13%. That just means for the most part, it just hovers here. And since it always hovers, it's never going to get on that significant list, despite a portfolio that does that. But they do that based on where they invest. You look at how they're set up, which is, I mean, oil, tech, 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 JP Morgan's banking, natural resources. Netflix is based on tech. You come over to Morningstar and you look at how the portfolio is set up. Now, this is just one part of it. This is the resources part. Energy, that's where we want to be, right? That's a bond proxy. Basic materials is not, but that also goes into the ability of those companies to fund energy. They're only invested into 55 different things. And look at where it is. Oil, oil, oil. If you don't know what it is on Morningstar, it will tell you what it is on Morningstar. Natural gas supplier, right? And that's all energy, energy transfer, oil, natural gas, except for a few funds. So oil in and of itself, like my favorite oil funds and energy transfer funds like KYN and NML are not on that discount list right now just because they're not. They don't meet the metric. And ADX gives us that backdoor play into energy inside they're already expanding. They're expanding growth. I like the consistent dividends. They used to pay, it used to be five, so same schedule, 5 cents, 5 cents, 5 cents, end of year 5 cents plus a giant special dividend. They've somewhat changed that into this track record. So 47, 46, 44, right? So I just have 46 because it's easy. That's about the midpoint of all of those things. But what I've argued for, and I don't know if anybody from ADX will ever see this, but what I've argued for is if they would pay a 45-cent dividend, same schedule, and switch it to monthly, 15 cents a month is amazing. It's the same overall payout, really. I mean, it's just this dividend paid quarterly, kind of quarterly, spread out over monthly. That would be amazing. And then at the end of the year, still pay the fantastic additional special dividend if it's there, right? And some years, if you look at their history, some years it's there and some years it's not. But switch it to a monthly, and I am sold. Like I would pick up another 100 set of this easy. But if you put it on a monthly pattern, that makes it so much more tempting because the dividend is now reliable and I can trust that I can get it every single month. So this is the list. Municipal bonds with some caution. No one knows what's going to happen to the long-term yield rate. Short-term rates dip. There's question on whether the long-term rates will too or not. So I'm still okay with finishing out. My goal has been to hit 1,000 shares of each of these. So I would pick up another 100 in each. I hit my 1,000 shares, and then I see what the market does. ADX, yeah, it's an easy pickup if it's before the ex dividend date because I have no desire to buy. That pays into the monthly payer. Like if I bought late and I get the dividend next month, that's appealing. If I miss the ex dividend date for the August payment, I have no desire to wait 3 months or 4 months in this case to where I get the next dividend. HFRO, real estate, yeah, the most significant discount. I still see hope and light at the end of their tunnel and not a train. These two, yeah, they're a great pickup together. BRW, bonds, and everything else. Um, it's still a great buy. It's higher than where we bought it. It's probably, I don't know, it's probably 70 cents higher than where we bought it. Uh, it's not as great a discount as it used to be, but it's still a decent pickup. HLB, I'm on the fence of. It's the same thing. Like I trust HFRO is a rebuilt bond hedge fund. They were all in on bonds and then switched with no explanation into real estate. And I stuck with them and I trusted them on that. To where I still see a lot of hope for them. HLB is kind of similar. It's run by the same people. So do I trust them on their 30% stake in Midwave Wireless? And I don't know. Straight out, I don't know. Adding 100 shares is not a big deal, but at the same time, I don't want to just throw out 100 shares just for the heck of it. And then CLOs, there's a lot of CLO options on the list. I would not stick money into all of them. So on my end of things, it requires a deeper dive and really looking into each one compared to the other and which gives us the best option. For sure, excuse me, for sure, I would pick up OXLC for sure. I don't know if I would pick up any of the others. And that's kind of what I'm going to look at. But I know the CLO market space has changed because OXLC used to have this fantastic dividend. And then, yes, it slowly went down and then it kind of climbed back up. It's not anywhere near where it was pre-COVID, but neither are interest rates really. Uh, but I know the CLO market space has changed because companies don't want to cut dividends. And OXLC already announced that they'll cut the dividend in October. So cutting it a cent is amazing compared to the price change. But at the same time, I mean, most people, it's kind of like you don't want to cut rates, like you don't want to cut the dividend at all. And you certainly don't want to look like you don't know what you're doing and you have to cut it again or a third time. So cutting it once and dropping it only a cent is not a bad deal overall. Buying at the bottom of the market or close to the bottom of the market when it should go back up, should. That's the market in general, should. When it should go back up, especially with an interest rate cut, that's tempting. I mean, that really is tempting for sure to pick up another 200 set and maybe more. So that's what I have for the week. I hate to be wishy-washy at the end with CLOs, but I need to deep dive this. And quite honestly, if you're going to invest in CLOs and you're not already invested into CLOs, you need to do a lot of research and see what your comfort level is. Because this dividend looks amazing, but you need to see if you think the company can sustain that and won't just cut the dividend in half, right? And kind of send you out to dry. Now, they're not doing it to just you, they're also doing it to the company. The company exists to make money, right? Every company exists to make money, and it is beholden to its stockholders to make money. So if paying a dividend out is going to actually create a problem for the company, they're not for that because their goal is to make money, not lose it. So if you're going to invest in the CLOs, I mean, I'll gladly give you my 2 cents of what funds we pick and why. But if you're going to invest in a CLO and you don't understand or know anything about CLOs, then it is up to you to do your own research and do a damn good job of doing that research and understand what you're getting and understand what you're investing in to the best of your ability. So that's what I have for the week. I will gladly give you an update on what we buy and when. Um, and then in general, I mean, I've got to update that Substack. Have to. Um, and that, well, I'll update you as I go. I have goals. I have goals for it. I've confirmed that Substack will do what I want to do with it. Uh, but that's a very different posting platform than every other social media platform. So I got to get used to that. Let's see. In the meantime, drop me a comment, like a video, share it, help somebody else out. There is a much better way to invest than the standard S&P 500 or the NASDAQ, where the average common yield is 1.2%. As you'll find, yeah, 31 is a little off, but even at 10% on tax equivalent, we'll say close to 9% is so much different than the 1.2 dividend you get every quarter versus some of these you can get every month. So yeah, know your strategy, know your risk, know what you want to invest, know where you want to go and why. Yeah, and if you have questions, by all means ask. So whatever you have for the week, I hope it goes well. What do you have for the full week? I hope it goes well. And yeah, my advice, see how far the market dips. Don't don't be so concerned with buying the bottom. Like don't try to get the inverse of the pinnacle. Don't try to time the exact lowest point of the trough. Don't try that. Buy the dip, see how the market goes, buy the dip, update your spreadsheets, update your systems, and then we'll see how it all plays out. And biggest thing long term is, gosh, ideally going back on a different actual fixed metal standard, or finding a Fed chair who will actually cut rates based on data, someone who will be reactionary. And if that means the rates need to go up, then that's based on data. And if rates need to come down, then that is also based on data instead of one man's power trip. So yeah, again, what do you have for whatever you have for the week? I hope it goes well, and I will see y'all on another video. So yeah, have a great week, everybody. Bye bye.